Value stocks versus growth. All right, my man Carl writes in. He says, "Hey Josh, another investment guy I followed raised an interesting viewpoint on value versus growth funds. He said in a low interest rate environment, value won't perform nearly as well as growth because access to capital is so convenient at discounted rates." What are your thoughts on this? If you're in an accumulation period, I get you have a long-term time horizon, but what if you're in a decumulation period? All right. Of all the arguments in favor of growth, this is the weirdest one to me. Is access to capital gone for value stocks? I mean, why? I don't get it. It's weird to me. So value stocks have low access to capital, or they don't have as much abundant access to capital as growth stocks do. That just seems weird. But let's look at history. I mean, I don't. They're not mutually exclusive. But growth stocks can put their money into growing their firm. Yeah. Well, they can also do acquisitions as well, and we know a lot of guys get hung up on acquisitions, which actually sink the boat. Look at Fox News buying a MySpace. Look at whoever bought. Actually, did Fox News buy Yahoo? Or no, what did they buy? Who bought Yahoo? I forgot. But anyway, I mean, the list goes on and on. These companies acquiring other firms that are just that bring them down. You can make a case Google buying YouTube. YouTube's a net loss leader for Google, but it gives them data to all kinds of information on all of us for sure that Google is willing to pay for, even though YouTube is losing them money. Is that sustainable? No, it's not. At some point, they're going to have to turn a profit, YouTube. Anyway, so let's go back to what we're saying here. Historically, we've had a 6% 10-year Treasury bond. All right, you always got to look at alternatives. So you're investing in the stocks versus bonds versus cash. In cash, we could talk CDs if we want. I don't care. All right, so that's what you're looking at. Versus real estate, by the way. Real estate's got to be thrown in there. Your home. You can invest in paying off your mortgage, buying another piece of property, all that. But essentially, for intangible assets, you're looking at three things: stocks, bonds, cash. All right, so stocks you buy, some people buy because of the dividend. Dividends historically have been about 5 to 6%. I mean 4 to 5%, excuse me, 4 to 5%. So for every $100,000 I get in, I have in stocks, I get $4,000 a year on dividends, historically. Now dividends are at about 2, all right? So right now we have about a 50% discount on dividends. So for $100,000, I'm getting $2,000 in dividends right now. Now, dividends historically, or now are taxed very favorably. That hasn't been the case all the time. So dividends right now are taxed as QDI, which means they're taxed much more favorably than OI, ordinary income. So from a dividend perspective, dividends are very attractive relative to historical bonds, because historically bonds paid 5% to 6%. So if I owned a 10-year Treasury and I was getting 5%, I had $100,000 in there, I was getting a guaranteed of $5,000 a year, of which I have to pay ordinary income tax on. But still, I was getting $5,000 a year versus a 4% dividend, which a lot of times back in the old days, I had to pay ordinary income that as well. So as you can see now with bonds, the 10-year Treasury trading at 70 basis points, I'm only getting $700 a year in income off every $100,000 I have invested in the 10-year. That's it. And I got to pay ordinary income tax on that $700. So my dividend right now from a stock to bond perspective, which the dividends have historically been lower than my bond income, my dividends now are 3 times as high, and net of tax is 4 times as high as my bond income. So inherently, dividends look much, much more valuable than bonds for sure. All right, and that's just, you can't argue that, my friends. Now, you'd make the argument, well, if the stocks are trading at nosebleeds, but the value stocks certainly are not. They're just not. So we're sitting there saying, okay, dividends are much more valuable right now than bonds. There's just no two ways around that. Now, the drawback, of course, is stocks have a premium because they are riskier than bonds. Government bonds have a guarantee not to go down. They will never go bankrupt. Government bonds. You can't say that about ExxonMobil. You can't say about GE. You can't say about any dividend stock. So now we look at value versus growth, and we say growth stocks have outperformed simply because of, the tech companies growing like, basically like monopolies. Essentially they're getting utility. They're basically growing like a utility where everyone needs them, and at some point they'll be regulated as such. So you can see that happen. It's going to come, man. It's going to come. So you're thinking, okay, if utilities are regulated, what does that do? Well, it ramps down their growth potential. But let's just say it doesn't happen for 50 years. All right, so utilities, so you got these stocks, Googles, Amazons of the world, they can acquire money cheaply to reinvest in in technology and stuff like that. In of itself, that doesn't mean that it's going to be profitable. It just does not, because Amazon is not profitable relative to its price to earnings ratio. It's just not. I mean, it's profitable, yes, but it's not. PE ratio is still through the roof. So Amazon has access to capital, but it's at some point their PE ratio has to come to make it not nosebleed. Facebook, I think Facebook's got 70%, a 70 PE. I think it does. Apple, Microsoft, yeah, they have access. I don't even know if is Apple even a growth stock anymore. I guess it would probably qualify, but still, they got a lower PE. They got tons of cash. They're paying a dividend. Microsoft, I think, has got a pretty high PE, if memory serves. I can't remember. Netflix got a pretty high PE. The big one's Tesla, all these companies like that. So, yes, they have access to cheap capital at discounted rates. But at some point, you got to turn the profits to make a PE ratio look worthwhile. You can't, I mean, again, the market can stay irrational. I mean, the market can stay irrational longer than you can remain solvent, is always the Ben Graham or Warren Buffett or somebody that said like that. But at the end of the day, you still have to have a PE ratio that's worth buying the stock for. And just because they can borrow at low discounted rates, I don't know, that doesn't tell me anything. In fact, again, dividend companies can do the same. Anyway, so I just split the difference to go all in on the S&P 500 or the total stock index. Hey, big man, Papa just made an appearance. Don't forget to paw the like button. There he is. Hope this helps, Carl. Thanks, now.